We are seeing very substantial inflation. Warren Buffett. Hey guys, it's John here. I make videos about investing, personal finance, and financial freedom. In this video, I want to share on how to invest during high inflation environment according to Warren Buffett. In January 2022, the US inflation rose to 7.5%, which was the highest in the last 40 years. In fact, in 1980, the inflation was at the highest. It was 13.5% in 1980. Before we start the video, I want to let you know that this video is not a financial advice. This video is made for entertainment purposes only. So please do your own due diligence before you make any investing decision. All right, let's get straight to the video. Let's learn from Warren Buffett, who has been investing in the last 50 years, including in the 1980s. All right, let's turn on to the shareholder letter in 1980. The first one was buy great businesses. What does it mean? According to the 1981 shareholders letter, the first involves companies that through design or accident have purchased only businesses that are particularly well adapted to an inflationary environment. Such favored business must have two characteristics. The first one, an ability to increase prices rather easily, even when the product demand is flat and capacity is not utilized, without fear of significant loss of either market share or volume. All right, so one of the industry that you can increase your price easily was customer staples. All right, so that is Procter & Gamble. In this article here, Procter & Gamble from this Yahoo Finance, it said, price increases will range from mid to high single-digit percentages. The hikes will go into effect in mid-September. So it is pretty easy in order for Procter & Gamble to increase the personal care products because everybody needs it. Everybody needs detergent, everybody needs razors. So it would be easy for them to do it. Okay, so for example, it's the industry. The second part is the ability to accommodate large dollar volume in increased businesses with only minor additional investment of capital. Warren Buffett said that it's better to avoid an asset-heavy industry. For example, utilities, because utilities required an additional investment of capital, such as utility company like Duke Energy. Okay, so what does that mean? Compare that to the high return on investing capital like Facebook. All right, let's look at Duke Energy. Okay, in this chart here, we can straight look at the return on invested capital from 2012 to 2021. As you can see, it's very low, 2%, 2%, 3%, 3.5%. Okay, so this is what Warren Buffett said, that he doesn't like a business that is asset heavy. And if you look at the capital structure here, the asset to equity is about 3.3. So it is a asset heavy business. And compared to Facebook, I actually have made a video on Facebook stock analysis after it dropped $200 billion, and I'll put the link somewhere up here. Okay, let's look at Facebook. If we look at that, ROIC is 19.3% in 2021. As you can see, Facebook 23%, 28, 19, 23, and 29%. So in Warren Buffett shareholder letter, he likes businesses that can produce income without spending too much money on additional investment capital. Okay, so that's the first two criteria that the Warren Buffett said, buy good businesses. The second criteria, in 1979, inflation went up as high as 11.25%. And in 1981, it was 13.5%. No wonder Warren Buffett wrote it in 1979. He said that we have achieved this result, which is the Berkshire annual result, utilizing a low amount of leverage measured by the debt to equity, and also without significant issuance or repurchase of shares. So Warren Buffett, they like businesses with low leverage. It produces a result without a lot of leverage. Okay, so for example, the low to debt equity ratio is Facebook. Let's look at Facebook again. In fact, if we go to Seeking Alpha and we go to Facebook, let's look at the debt to equity. We go to financials here and we look at overview. Okay, go right to the bottom. It said here the debt to equity 11.57%. Very low debt to equity ratio, while they were able to achieve about 19% return on invested capital. Okay, let's look at Procter & Gamble. Let's compare it to Procter & Gamble with high debt to equity ratio. So Procter & Gamble, if you look at this, the debt to equity ratio is 79%. It's very high. I would say avoid high debt to equity ratio companies. All right, so that was the second one. Buy businesses with low leverage. And the third criteria, buy businesses with high cash flow. Again, in 1980 shareholders letter, it says, our acquisition preferences run toward businesses that generate cash, not those to consume it. As inflation intensifies, more and more companies find that they must spend all funds they generate internally just to maintain their existing physical volume of business. This can talk about advertising. Maybe there are some companies, in order for them to keep their revenue, they need to keep on spending cash, like advertising. And it says here, however attractive the earning numbers, we remain leery of businesses that never seem able to convert such pretty numbers into no strings attached cash. This talks about businesses that promises they are growing fast. They have very attractive earning numbers, either this year or in the following years. But some of those businesses, they need a lot of cash to maintain. This talk about, for example, tech companies. Technology companies, they are giving discounts to bribe customers, for example. I shouldn't say the word bribe, but they're giving a lot of discounts, 50%, 70%, whatever it is, in order for them to generate revenue. And this is quite common for tech companies, new businesses, startup companies. So Warren Buffett personally doesn't like that. He likes businesses that already generate cash with whatever capital that they have. Find companies that generate positive free cash flow, like Facebook. If we look at Facebook, we can see that their free cash flow is about 45% in the last 10 years. That FCF is positive cash flow. It is a cash generating machine. If we look at the financials of Meta, shouldn't call it Facebook, let's go to cash flow. And this is from 2012 to 2021. If we look at the cash from operations, they kept going up. They kept going up. And if we look at their cash flow, they kept going up steadily, consistently. So this is the business that Warren Buffett would say. Again, some people can argue Facebook is a business that cannot just increase their revenue, but in my opinion, I think they can. I have talked more in detail about Facebook analysis in my other video. Please check it out. So thank you so much for listening to me until the end. Until next time, I will see you guys in the next video.